All right, so welcome back to Talk Tickers, the show that, well, we like to say we cut through the noise of earnings calls and bring you the insights that, the stuff that you can actually use.
Yeah, no more wading through pages of transcripts.
Exactly.
We do the heavy lifting for you.
That's it. And today we're diving into Duluth Holdings, their Q4 2024 earnings call.
Oh.
So this one, I gotta say, there were some interesting nuggets in here.
Oh, yeah. There's a lot going on with this company, a lot of moving parts.
Definitely in a state of transition.
Yeah.
So maybe the best place to start is, top level. What kind of results do they report for the quarter and for the full year?
Yeah, sure. So for the fourth quarter of 2024, Duluth Holdings reported a decrease in net sales, about 1.8%, down to $241 million.
Okay, so a slight dip in sales.
Yeah, not a huge drop, but not great either.
Right.
And the direct sales online, those stayed pretty flat, which is interesting because they saw an increase in people buying through their phones.
So the mobile channel is picking up for them.
No, absolutely. Yeah. That growth on mobile actually offset a decline in traffic to their main website.
Makes sense. I mean, everyone's on their phones these days.
It's the world we live in, right?
Exactly. So that kind of helped keep their online sales stable. Now, what about their retail stores? I mean, those are a big part of their business.
Yeah. So unfortunately, their retail store sales actually saw a bigger decline, about 6.9% lower, mostly due to less foot traffic.
Okay, so the in-store experience is struggling a bit more. Got it. So a mixed bag overall on the sales front. Now, what about the bottom line? What did their profitability look like for the quarter?
Well, their adjusted EBITDA for the fourth quarter came in at about $9 million.
Okay, and what about for the full year?
So for the full year 2024, their total net sales reached $627 million, and their adjusted EBITDA was $15 million.
All right, and anything else noteworthy on the financial side before we dig into the specifics of what they talked about on the call?
One thing that really stood out to me was their balance sheet. They actually ended the year debt-free with over $100 million in liquidity, $103 million to be exact.
Wow, that's a pretty solid position to be in, especially in this economic environment.
It gives them a lot of flexibility to maneuver, invest in growth or weather any storms that might be coming.
For sure. So they've got the cash now. Let's talk about how they're planning to use it. What were some of the key themes or challenges or strategic initiatives that they highlighted on this earnings call?
Well, one thing they addressed head on was a pretty significant challenge they faced with their order fulfillment process.
Oh, really?
What happened? It sounds like they had a much stronger than expected Black Friday, Cyber Monday weekend.
Which is usually a good problem to have.
Right, you'd think so, but it ended up depleting the inventory at their main fulfillment center in Adairsville, Georgia.
Uh-oh, so they ran out of stuff to ship.
Pretty much, yeah. And this cascaded into problems at their older facility in Belleville, Illinois, which just wasn't equipped to handle the sudden surge in orders.
So it sounds like a classic case of, success breeding its own set of problems.
Exactly. And they admitted on the call that they experienced some significant processing delays as a result.
It's not good, especially during the holiday season when people are expecting, quick turnaround on their gifts and all that.
Right. It definitely impacted their customer experience, I'm sure.
So what are they doing to fix it?
Well, they said they've already implemented enhanced protocols and planning processes to try to avoid this kind of bottleneck in the future.
Okay, so hopefully a lesson learned.
Hopefully, yeah.
So that was one of the challenges they discussed.
Yeah.
What about on the more positive side, any strategic wins they highlighted?
Well, one thing they're pretty excited about is their so-called Big Dam Blueprint.
I love that name.
Yeah, it's a catchy one.
Very Duluth, very on brand.
Exactly. And one of the key elements of this blueprint is their move towards direct-to-factory sourcing of their products.
Okay, cutting out the middleman, essentially.
Exactly. And it sounds like this initiative is really paying off. They said it's exceeding their expectations in terms of both lowering product costs and allowing them to bring new products to market faster.
Interesting. So kind of the double win there. They're getting more efficient on the cost side, and they're also able to be more agile in terms of responding to trends and, keeping their product line fresh.
Right. And that agility is so important these days with how quickly consumer tastes are changing.
Couldn't agree more.
Yeah.
So it seems like they're really focused on streamlining their operations, both in terms of where they're sourcing their products and how they're getting those products to customers.
Absolutely. And that streamlining is evident in their logistics as well.
Okay. Tell me more about that.
So their newer fulfillment center, the one in Adairsville that we talked about earlier, that one's now handling over 60% of their total shipping volume.
Okay, and I'm guessing that's a good thing.
It is, because they're claiming that the cost per unit shipped from that facility is dramatically lower, about 66% lower than their older facilities.
Wow, that's a huge difference.
It is. And on top of that, they've also closed their Dubuque facility, which is going to save them about $5 million annually.
Okay, so they're consolidating their fulfillment operations into these more modern, more efficient centers.
Exactly. It's a pretty classic playbook for retailers these days, but it seems like Duluth is really starting to see the benefits of that strategy.
Right, so they're getting their house in order on the back end.
Hmm.
Now let's talk about the customer-facing side of things.
Mhm.
We touched on this earlier, but their mobile sales seem to be a bright spot. So what's their overall digital strategy looking like these days?
Yeah, so they're definitely all in on mobile. They reported that almost 70% of all visits to their website now come from mobile devices, and mobile users account for nearly 58% of their total digital sales.
Wow, so the majority of their online business is happening on phones now.
Yeah. And what's really encouraging is they're seeing strong conversion rates on mobile, meaning people who are browsing on their phones are actually buying at a pretty good clip.
That's great news for them because I know a lot of retailers struggle with, getting people to convert on mobile. It's a different shopping experience.
Totally different. And they know they need to keep investing in that experience. They mentioned on the call that they're going to continue to pour resources into their omni-channel strategy.
Okay, so making sure that the shopping experience is seamless, whether you're on your phone, on your computer, or in one of their stores.
Right. Creating that kind of unified experience is really the holy grail for retailers these days.
Absolutely. So it sounds like they're making progress there. Now, what about their physical stores? We talked about how their in-store sales were down. Are they shrinking their footprint or are they still opening new locations?
So it sounds like they're taking a much more strategic approach to their brick-and-mortar presence.
Okay, so not just opening stores for the sake of opening stores.
Right. They've actually raised the bar in terms of what they expect from their stores, both existing stores and any new ones they might open.
So higher productivity hurdles.
Exactly.
Hmm.
By 2026, they have leases coming up for renewal on about 25% of their existing stores, and they're going to be evaluating each one very carefully.
So potentially closing some underperforming locations?
It's on the table. They'll be looking at, whether to remodel, relocate, or even exit those stores, depending on whether they meet those higher productivity standards.
Okay, so kind of a right sizing of their physical footprint.
Yeah, I think that's a fair way to put it. Now, they did say that they have 2 new store openings planned for the second half of 2025.
Okay, so not abandoning brick and mortar altogether.
No, but it seems like a very measured and targeted expansion rather than, just trying to grow for the sake of growth.
Right. Quality over quantity makes sense. Okay, so we've talked about their operations, their digital strategy, their physical stores. Now, let's get under the hood a little bit and talk about the technology that's powering all of this.
Oh.
Anything interesting happening on the tech front?
Yeah, so they've actually completed some foundational work on their data and e-commerce platforms, which is a good starting point.
Okay, so laying the groundwork.
Exactly. And their technology roadmap for 2025 includes some pretty significant projects. They're planning to launch a new product information platform, which should help them manage their product data more efficiently. They're also going to be overhauling their mobile site, which makes sense given how important that channel has become for them.
Right. Got to keep that experience top notch.
Absolutely. And they're also going to be finishing the implementation of their warehouse management system, which should help with, all that logistics streamlining that we talked about earlier.
Right. So these are all kind of behind the scenes upgrades, but they're all geared towards, ultimately improving the customer experience and making the business run more smoothly.
Yeah, it's all about investing in the infrastructure that will allow them to scale and be more competitive in the long run.
Absolutely. Now, what about beyond 2025? What's further down the line on their tech roadmap?
Well, some of the things they mentioned that are further out include implementing a unified system for managing promotions.
Okay, so like a centralized platform for all their deals and discounts.
Exactly. They also want to launch a customer loyalty program, which is something they don't currently have.
Interesting. So a way to, reward their repeat customers and build some brand loyalty.
Right. And perhaps the biggest project on the horizon is a complete replacement of their enterprise resource planning system, or ERP system, as it's known in the industry.
Wow, that's a major undertaking.
It is. ERP systems are kind of like the central nervous system of a company. They touch every aspect of the business.
So this is a sign that they're really serious about, modernizing their entire technology stack.
Absolutely. It's a big investment, but it could pay huge dividends in the long run.
For sure. Now, one other thing I wanted to touch on before we move on, they talked a bit about inventory management on the call, and I know that was an area where they had some challenges last quarter. So what's their approach to inventory going forward?
They're definitely laser focused on getting inventory right in 2025. Their goal is to make sure they have the right products in stock at the right time, and they're really emphasizing the use of customer insights and data to inform those decisions.
Okay, so making data-driven decisions about what to stock and where.
Exactly. And they did mention that their inventory position improved somewhat by the end of February. They had good stock levels on their core year-round items.
Okay, so hopefully they're starting to get a handle on that piece of the puzzle.
We'll see how it plays out in the coming quarters.
All right, so let's circle back to the financials for a minute. We talked about the top-line sales numbers, but what about their profitability in the quarter?
So in the fourth quarter, they reported a loss per share of 17 cents, which translates to an adjusted loss of 4 cents per share.
Okay.
Now, here's where it gets interesting. They actually saw some improvement in their direct product costs, meaning the cost of the goods themselves went down.
Okay, so that's a good sign.
You would think so, but their gross margin actually contracted by 410 basis points, which is a pretty significant drop.
Wow, so what happened there?
It seems like the main culprit was a decrease in their average selling price per item. They reported that their AUR, or average unit retail, declined by 8.9%, which suggests they had to use more promotions or discounting to move product.
Ah, so they had to sacrifice some margin to drive sales.
Exactly. It's a balancing act, and it looks like they lean more towards driving sales in this quarter.
Okay, and what about their operating expenses?
Their adjusted SG&A expenses, which include things like marketing and salaries and store operating costs, those decreased slightly by 1.3% to $107.7 million.
Okay, so a little bit of cost control there, but not enough to offset the margin pressure.
Right. It was really that AUR decline that drove the overall profitability picture for the quarter.
Got it. So that was the quarterly view. What about the full year? How did the financials shake out for all of 2024?
So for the full year, their net sales were down 3.1%, landing at $626.6 million.
Okay.
Their gross margin for the full year also saw a decline, though a smaller one of 110 basis points.
All right, so they were dealing with some margin pressure throughout the year.
It seems that way. And ultimately, they reported an adjusted net loss of $23.6 million for the full year.
Okay, so a challenging year overall in terms of profitability. Now, the big question is, what do they expect going forward? What did they say about their outlook for the current fiscal year, 2025?
Well, their guidance for 2025 gives us some insight into their priorities.
Okay, so what are they focusing on?
They're projecting net sales to be in the range of $570 million to $595 million, which suggests they're anticipating continued pressure on the top line.
I was not expecting a huge rebound in sales.
Not at this point. But here's the interesting part. They're actually forecasting a pretty significant improvement in their gross margin. They're expecting it to expand by approximately 300 basis points, or 3%.
Wow, that's a big jump. So it sounds like they're really banking on those direct sourcing efforts and maybe some less promotional activity to boost their profitability?
Yeah, it seems like they're willing to potentially sacrifice some top-line growth in order to improve the quality of their sales and get those margins back up.
Interesting. So kind of a shift in focus from growth at all costs to, profitable growth.
Exactly. I think that's a fair assessment.
Makes sense. Now, what about their expenses and their overall profitability expectations for the year?
So they do anticipate that their SG&A expenses will increase slightly as a percentage of sales, what's called deleveraging, by up to 200 basis points.
Okay, so a little bit of expense pressure there.
Yeah, likely due to fixed costs being spread over a slightly lower sales base.
Right. And what about their bottom line? What kind of adjusted EBITDA are they projecting?
They're projecting adjusted EBITDA between $20 million and $25 million for fiscal year 2025.
Okay, so aiming for profitability.
Definitely. And they also mentioned that they're planning capital expenditures of about $20 million.
All right, so continuing to invest in the business. Okay, so a lot of moving pieces there on the financial front. Now, there was one other big piece of news that came out of this earnings call, a change at the very top.
Oh, yeah, that's right. CEO Sam Sardo announces retirement effective April 25th of this year.
Okay, and who's taking over?
So this is where it gets interesting. The company's founder and chairman, Steve Schlecht, actually stepped back into the day-to-day operations on March 14th.
Wow, so the founder is back in the saddle.
For now, yeah. It's an interim role to ensure a smooth transition while they conduct a search for a permanent CEO.
Okay, so A bit of a surprise move, but I guess when the founder is still around and willing to step in, it makes sense.
Definitely. And it'll be interesting to see what direction he takes the company in during this interim period and who they ultimately choose as the next CEO.
Absolutely. All right, so we've covered a lot of ground here. It's been a pretty dense earnings call.
Yeah.
So maybe just to wrap things up, what would you say are the key takeaways, the things that investors should really be paying attention to when it comes to Duluth Holdings?
I think the main takeaways are they definitely face some operational headwinds in the last quarter, especially with those fulfillment issues, and their profitability was definitely impacted by that increased promotional activity.
Okay, so some challenges to work through.
For sure. But on the positive side, they're making some real strides in optimizing their supply chain and their logistics, particularly with those direct sourcing initiatives and the efficiency of their newer fulfillment center.
Right, so getting leaner and more efficient.
Exactly. And their digital business continues to grow, especially on the mobile side, which is encouraging. And they're taking a more disciplined approach to their physical stores.
So a more strategic approach overall.
I think that's a good way to put it. And looking ahead, their guidance suggests that they're really focused on improving profitability, even if that means potentially accepting some slower top-line growth.
So quality of sales over quantity of sales.
Right. And then, of course, there's that leadership transition, which adds another layer of uncertainty, but also potential for change.
Absolutely. It's definitely a company in transition, but it seems like they have a plan in place to address their challenges and capitalize on their strengths.
I think that's a fair assessment.
All right, so that was our deep dive into the Duluth Holdings Q4 2024 earnings call. Hopefully, we've given you a good sense of what's going on with this company and what to watch for in the coming quarters. But now it's time for our favorite segment. This is not financial advice.
The time where we let our imaginations run wild.
Exactly. We're not giving financial advice here, just throwing out some ideas, some food for thought.
Some potentially outrageous but plausible trade ideas.
That's it. So given everything we've just discussed about Duluth, their focus on operational efficiency, their challenges with their fulfillment network, and their acknowledgement that, logistics is a key area of focus. Here's a thought.
I'm listening.
What if we think about a paired trade within the retail sector?
Okay, a pairs trade. I like it.
Yeah. So on one side of this trade, you would be looking at companies that are really heavily investing in and successfully deploying advanced automation within their warehouses and their logistics chains.
Okay, so think robotics, AI-powered systems, that kind of thing.
Exactly. The companies that are really on the cutting edge of logistics technology and seeing real results in terms of reduced fulfillment costs, faster delivery times, all that good stuff.
Makes sense. And
Yeah.
the other side of the trade?
The other side would be looking at retailers that seem to be lagging behind in this area. The ones that are still relying on more traditional, maybe less efficient infrastructure, and maybe even seeing their logistics expenses start to creep up as a result.
So the ones that are kind of stuck in the past when it comes to their fulfillment operations.
Exactly. And, the contrast between Duluth's older Belleville facility and their newer, more efficient Adairsville Center really highlights this potential performance gap between the leaders and the laggards in this space.
Right. It's like a microcosm of the broader trend.
Exactly. So the idea here is that the retailers that win the logistics game are going to gain a significant competitive edge in the years to come. They'll be able to offer faster shipping, lower prices, and just a better overall customer experience.
And the ones that are slow to adapt, well, they might get left behind.
It's a bet on operational prowess becoming a key differentiator in retail.
I like it. It's thinking outside the box, but it's grounded in the realities of the industry.
That's what we aim for here in our This Is Not Financial Advice segment.
Always pushing the boundaries.
So there you have it, folks. That was your deep dive into the Duluth Holdings Q4 2024 earnings call. We tried to pull out the key insights, the things that we think are really important for understanding where this company is heading. But as always, this is just our interpretation, not financial advice. Always do your own homework before making any investment decisions.
Don't just take our word for it.
Exactly.
Yeah.
Now we'd love to hear what you think. What stood out to you from Duluth's report and their plans for the future? Join the conversation, let us know.
We're all ears.
And until next time, happy investing.
And stay tuned for more deep dives.